It has been a brutal month for tech stocks, with most of the Magnificent Seven going down by 10% or more in the last month alone. I'm joined by my head of AI research, Arif, and my good friend Larry, who's been investing in tech stocks professionally since the dot-com bubble. And in this episode, we'll cover the earnings calls for many of my top stocks to get rich without getting lucky in 2024, including Microsoft, Google, and Amazon. We'll also dive into Tesla and Meta Platforms, two stocks that should be on every investor's radar after some action-packed earnings calls. There's a ton to talk about, and your time is valuable, so let's get right into it. Arif, why don't you roll us right into Microsoft?
Yeah, let's take Microsoft as the first company. So results were better than expected. So let me take you through the numbers. So the operating income was 27.9 billion, which was an increase of 15%. These are year-over-year increases. Net income, 22 billion, 10% increase year-over-year. Earnings per share came in at $2.95 versus $2.93 expected by the market, which was up 10% year-over-year. And revenue, pretty much on the nose. It was revenue of 64.73 billion was what they reported, and what was expected was $64.39 billion revenue was expected. So like pretty much exactly nailed on with what expectations were. And that revenue was up 15% year over year. So sounding really positive. Their cloud revenue is the real thing that caused people concern. And when I first read these numbers, I thought it was maybe an overreaction because cloud revenue actually increased 29%. This is the first quarter after 4 consecutive quarters of increasing growth that the cloud revenue are up less than they were previous quarter. So the previous quarter was 31, and before that it was 30, and before that it was 29. So I think that's what really drove this stock down in terms of the market reaction.
Yeah, I actually spent some time digging into what else could it have been, because it's pretty shocking to me that the stock could tumble on 29% revenue increases of their cloud business. It's not going to accelerate every quarter, right? This is a $3 trillion company. This is one of their biggest business segments. There's no way that's going to grow 30, 40, 50% year over year, especially when it's competing with Amazon Web Services and Google Cloud. 29% increase year over year is still incredible. In fact, if it stabilized at 29% year over year every year, this would be one of the best businesses in the world of all time forever. So it's crazy that it dropped on 29% revenue increase of such a large business unit versus an expectation that was so close to it, 31%.
There's a theme we'll talk about here, which is the expectations are so high. Right now, the run-up that we had a few months ago, these stocks are priced for perfection. And they're also, everyone's talking about AI growth. AI is everywhere. So the market is expecting continual expansion, expecting the numbers to be up. And I think that's what we'll see when we go through a lot of these companies is expectations are so high that if you miss even by a bit, it does impact you in a big way.
And one thing I do want to call out, speaking of AI, Microsoft said that 8% of that 29% cloud revenue growth came from AI services, up from 7% last quarter, 6% the quarter before. So AI is taking a larger and larger share of that growth and a larger and larger share of that revenue. That's the first point I want to make. The second is actually the opposite. Most of Microsoft's cloud revenue is still coming from non-AI workloads. So that bodes really well. It's not like they pivoted too fast and growth is slowing because they're too aggressive on AI and the growth isn't there. That's actually not true at all. And just based on everything that Jensen has been saying at NVIDIA, we know that AI workloads are going to grow exponentially for the rest of the decade, which means Azure, Amazon Web Services, and Google Cloud are going to be serving more and more of these workloads. They're going to exponentially grow over the rest of the decade.
Yeah, I think the launch of their Copilot PCs is another big thing. So you were just talking about AI there. People right now want to invest in companies that they think are going to benefit from the AI wave. Here's a different dimension where Microsoft is going to bring in AI revenue with this whole concept of Copilot PCs. That is something new that they're bringing to market. And although in some of these, they're being delivered by partnerships where maybe an AMD or a Qualcomm or an Intel are providing the CPU, don't forget they're also partnering and producing their own Surface tablets as well. So Microsoft will be having a direct revenue line from some of these devices. So this is a key driver for them, and it allows them to get not just the AI workloads that are going to the cloud on the data centers, but also AI running on the edge. This might reinvigorate the whole client segment, and Microsoft will be a direct beneficiary from that revenue.
The cloud business is booming. The edge AI business is booming. So the third part of Microsoft that we should talk about is actually their partnership with OpenAI, right? We've covered cloud, we've covered the edge. Now let's cover the elephant in the room. OpenAI directly competes with Microsoft in a few ways now. Microsoft Copilot is in direct competition with ChatGPT, and Microsoft Bing is in direct competition with SearchGPT, which recently got announced. Do you think that Microsoft shareholders should be worried about competition from OpenAI, or is this a healthy form of competition where SearchGPT could make Bing better?
Yeah, my view is without ChatGPT, without access to OpenAI, like Copilot would never have launched as quickly as it did. So I think actually Microsoft are in a really strong position. I think they'll be able to leverage that. They will share the R&D, and actually it'll be a partnership that will help both sides over time. But I can see why people are questioning it.
Yeah, I'm actually in the exact same camp as you. I think every time OpenAI innovates, Microsoft is the primary beneficiary. So I'd be really surprised if OpenAI really launched something that flat out killed a Microsoft product without Microsoft having a way to leverage that inside that product. So I think SearchGPT is going to be more of a advantage for Microsoft than a detriment. Larry, what do you think about Microsoft stock in the short term? Show us a chart and tell us, is it a good buy now? Should we be waiting? What should we be doing?
Sure. So where we're at with Microsoft, so a couple things. So first of all, I've got a long position in Microsoft. I agree with both of you. I think that Microsoft, at least for me, it's a top 5 core artificial intelligence stock. So longer term, I love Microsoft. In the shorter terms, it is obviously pulling back with the rest of the market. It's pulling back with the rest of the tech sector. And if we take a look at the chart, the recent high for Microsoft came in July 8, looks like 467. Now, just a couple days after that, July 11, the CPI came in much lower than forecast. And when that came in much lower than forecast, there was a very sharp rotation out of tech stocks in general and into small caps, home builders, banks, real estate stocks, things like that. So I think that
that's because there's an assumption of a rate cut, right? This is happening because, okay.
There's an assumption of a rate cut, and cyclicals tend to perform better. So I think a lot of the pullback that we're seeing in a lot of these tech stocks is really two things. They did get to be, we could call it over-owned. The ratio of the NASDAQ Magnificent Seven versus the S&P 500, there was a lot of indicators that said that these stocks could be overbought, they could be overextended, but they kept going higher until we got that macro move out of tech and into cyclicals. So where Microsoft is on the chart right now is I'm holding my Microsoft. I'm not adding to it. And what I'm looking at on the chart is my key line in the sand as far as if I want to buy a stock, add to a position or not, is the 50-day moving average. And on this chart, that's going to be the red line. So what I do is once a stock starts to drift below that red line, I basically take it off my list as far as do I want to add money to it right now. Microsoft is sitting right on the 200-day moving average, which is the green line. And that's often considered by many institutions the key line that determines is the stock in a longer term uptrend. It's considered positive above the 200-day, or is it starting to break down? So what I'm doing is I'm holding my Microsoft. I'm not adding anything to it right now. And I want to see how these charts develop over the next week or two. But I will say this. I think that all of these stocks that we're going to talk about will be buyable on this pullback. We've got the elections coming up, so that adds to uncertainty. So as far as how far does this pullback go? Does it end today? Does it end in 2 weeks? I don't have a prediction there, but I do expect that these high quality stocks like Microsoft will be buyable.
Well, that's good because the next stock on our list, I think, is the one that everybody wants to know whether it's viable. So, Arif, why don't you tell us about Tesla?
Is there another stock out there that divides opinions as much as Tesla? They had a very challenging quarter, to be honest, really. So they announced their results, and the big headline really was the fact that auto revenues declined 7% versus this time last year. And also at the same time as their revenues decreasing, the worst thing is their margins were also falling as well. Their operating margin shrank to its lowest level in 3 years. So now their operating margin is 14.4%. From 18.7% a year earlier. It's the fourth straight quarter of shrinkage of their operating margin. And I think this is a crucial thing because people who are bullish on Tesla, their view is it's more of a technology company, and its margins have suggested that in the past. Now, with the margins where they are, it's coming more in line with a normal kind of auto company, if you like. The auto revenue, we had 19.9 billion this quarter, which was actually up a little bit from the previous quarter, but it's the year over year where it was down. So previous quarter was 17.3 billion. And then energy storage, a bit of a surprise here, 3 billion of revenue in the quarter versus 1.6 billion the previous quarter. So that energy storage business, which doesn't get much coverage, I was quite surprised. Even in the CNBC article announcing earnings for Tesla, it doesn't mention it at all. So the stock market reaction, as you can imagine, was not pretty. The stock was down 12% after earnings, the biggest fall since 2020, really because of the auto revenues down year over year, 7%, and also the margins falling.
So my first and main question, is Tesla doomed? 4 quarters of shrinking sales, shrinking revenues, shrinking margins. I do view this as a technology company, but it's a technology company built on top of an automotive platform. If you hadn't mentioned energy just there, I think the situation for Tesla and Tesla shareholders is actually pretty dire. I'm sure I'm being overly bearish on Tesla right now. So help me calibrate and help me understand what is the positive view of Tesla today.
Let me take the opposite. I'll be ultra bullish. So here's the ultra bullish story. Right now, Tesla's facing a lot more competition from Chinese auto manufacturers, but it's still by far the biggest seller of EVs in the US. And their market share is not going anywhere. It is under attack a little bit because of lower cost models, but they have an answer to that. So they have this new lower cost model that they've been talking about for a while. They are now saying at the start of next year, they're going to be able to start putting that out there. Previously, they're having to reduce the prices of the Model Y, the Model 3, etc. But now they will have a cheaper platform that will allow them to capture that market and also open up the market to people who haven't been able to afford an EV in the past as well. So that's one of the catalysts. And then the other catalyst is around the whole autonomous side and the robo-taxi side. So this is a question about, do you believe in the thesis of full self-driving? Not surprisingly, it came up on the earnings call again. It was another topic. And Elon said, take whatever he says with a pinch of salt. Of course, we know how good his estimates are normally. I think he said he would be surprised if we didn't have the first robo-taxi ride next year. And the model that he spoke about as well is you're a Tesla owner, you own the car, but when you're not using it, it can be used as a taxi and you get some money back. And actually this year, they will argue 2024 was always going to be challenging. It was a gap, if you like, between that newer model coming out and autonomous not quite being there. So it's been quite volatile. It's always been volatile. So it really divides opinions.
How should shareholders be valuing Tesla's energy segment? So the reason I ask that is because when we're talking about auto, when we're talking about robo-taxi, when we're talking about the next model, when we're talking about Optimus, we're fundamentally talking about AI and robotics. But when we talk about Tesla's energy storage segment, it seems to me that's not what we're talking about. That's not AI and hardware, right?
It's tricky, right? It's almost like as an investor, you tend to invest in things you really understand and the fundamentals of. With Tesla, you need to be like an automotive expert and you need to know about AI, you need to know about robotics. And by the way, how good's your energy storage knowledge? They used to have battery days, didn't they, as well, Tesla? So
that's right. Yep.
I think
absolutely
what it does, if you think about the concept of TAM, total addressable market, I think at the moment with the autos, that's everyone who's driving a car is your target market. With the robots, that's probably even narrower. Whereas if you're talking energy storage, that is, if you look at the macro trends in the world, that problem is not going anywhere. That's an increasing problem right now. We have to transition to more sustainable sources of energy. That's Tesla's core mission. So if you're doing that, and you need a grid that can provide energy at different times of the day, peak versus the nighttime, there needs to be storage for that to work. So actually, this might be a way for them to hugely increase their TAM. It's not their core area, but the growth is really encouraging. And I'd love to see where this energy business is in a year from now. Because if it continues that same growth trajectory, it's going to surpass some of their other areas quite quickly.
My worry about that happening is that sounds great. Obviously, I want all of Tesla's business segments to do well, but that sounds like a much lower margin, harder to break into segment with a lot more competition. You're competing with utilities, which are some of the biggest competitors on earth, right? And I think that's a much harder competition for much fewer free cash flow dollars. I would be worried long term if the big shiny gem in Tesla's portfolio starts being their energy business as opposed to robo-taxis, training as a service, humanoid robots, right? All the other things that we've come to know and love about Tesla. So I am really excited to see what happens with the robo-taxi event, what the next upgrades to Optimus look like, where their energy business goes from here and beyond. So it is an exciting company to hold for sure. Is this a buy the dip opportunity? What do you think, Arif?
The thing about Tesla's is it trades at a very high multiple. It is a very popular stock. A lot of retail people talk about it passionately, talk about it online as well. We'll see a lot of Tesla bulls out there. It's choppy waters at the moment. And the thing is, what you just described, that it seems to be week to week, the news narrative changes. 1 minute, robotaxi event is announced for August, and suddenly the stock pops, and then it's delayed till October, the stock falls. With Optimus, I think Elon has now set a date of 2026 for the first Optimus production models to be available. So that's another delay. So there's always these things with Tesla. It's definitely not a smooth ride. It's not boring either.
Speaking of bumpy rides, Larry, why don't you walk us through what you're seeing with Tesla stock?
So I will say this. I agree with both of you. I agree that Tesla has a lot of potential exciting upside with energy storage, AI. And I also agree that this is an interesting time to look at accumulating the stock, but it goes back to a couple things. So if we look at the recent peak in Tesla, it was July 11, this was the exact day of the CPI. So once again, that sector rotation. But Tesla was trading nicely. So it had been building a base from, we'll call it 160 to about 190 on the chart. It was trading sideways for about 2 months. And then I think this was a combination of Elon announced the August robo-taxi debut. So what I see for Tesla right now, and we can dial back to the weekly, is there is a lot of support on the chart from 180 to $200. So it's trading at 207 right now. So I do expect in the next 6 months to a year, however we want to look at the time frame, I do think Tesla is going to be a lot higher, but I think right now we still have to get through this seasonal weakness. I'm not a big fan of buying anything on the way down. So I am a big fan, and Alex, you and I talked about Tesla a few times right before this breakout. So I am a big fan of buying things as they start to break out with the institutional buying. Longer term, I am very bullish on Tesla stock, but as far as when I'm actually going to start to buy it, I would want to see some more stability with Tesla chart. It's down 4% today. I'd want to see some more stability with Triple Q, but I'm just waiting right now. And that's the nice thing. If you have a little bit of patience and a little bit of extra cash, you can just really wait for the prices to come back a little bit and then start some good longer term positions. But longer term, I am bullish on Tesla.
On the other side of the cage match from Elon Musk is Mark Zuckerberg and Meta. Should we talk about that company next?
Yeah, and of all of the earnings, this one was probably the most straightforward story. And actually, the stock reacted well as well because their numbers were good. So they talked about revenues of $39 billion for the quarter, which was higher, a beat in terms of the $38.3 billion that was expected. Earnings per share came in at $5.16 versus $4.73. And the big drivers here were their operating income as well increased, but also their margins expanded once again. So their operating margin expanded to 38%, and it was 29% a year ago. And also the last cherry on the cake, really the guidance for the next quarter, Q3 was also higher than expected. It was in the range of 38.5 billion to 41 billion. So if you take the exact middle of those, you get 39.75 billion, and analysts were looking for 39 billion. So the numbers were really good. Revenue grew 20% year over year, which was also, it was the fourth straight quarter of growth above 20% for Meta. So as you can expect, the stock market reaction was positive before some of these macro issues with tech and this rotation took hold. So actually after earnings, the stock was up 7%.
What do you think is the primary driver of that strong quarter? Do you think it's like their year of efficiency from 2 years ago? Do you think it's their AI initiatives today? What do you think is going on to drive like these insane numbers?
So it turns out that actually Facebook, word we don't hear that often, yeah, that original platform, that growth on Facebook is coming back, which is not what people would expect. But also, as you touched on, that cost cutting in 2022 that was done at the time when Meta was really hemorrhaging money a lot. The company took on so many additional workers during the pandemic that they just were overweight. And so the company eliminated, I think it was 21,000 jobs were cut during those cost cutting round in 2022, the back end of 22. And so they've been able to continue to spend capex, like their capex expenditure is not reducing. It's still really high. So they're still able to spend at those levels, but it's that cost efficiency cuts, I think, in 22 that were the real driver, and their traditional business is growing as well.
It's important to really highlight too that even though their their spending is staying the same, what they're spending it on is fundamentally different than what it was in 2022, right? It used to be all about the metaverse, reality labs, and today they're spending a lot more on GPUs and AI infrastructure and data center software and hardware. But also that infrastructure down the line can be used for their metaverse initiatives as well. A lot of the metaverse will be built on servers with GPUs and accelerated computing. We see this with NVIDIA. We see this with Omniverse. We see this with all sorts of third-party platforms that are very graphically intensive. So I do think that the belt tightening from 2022 has really helped Meta up their game in several different ways. They're more efficient as a company, but also their priorities are now in alignment with short-term benefits. For example, advertising revenue on their platform by doing better content, ad, and consumer matching, as well as their long-term initiatives, which I still do believe include the metaverse just further down the line. All of these CapEx investments are pointing them in great directions in the short term, in the midterm, and in the long term.
One question that came up in the earnings call from investors on that was to say, look, when will you see new streams of revenue from this AI CapEx expenditure? Companies like Meta be able to bring in even more ad revenue, say from Facebook, because they're using AI in innovative ways. Like that area is still, the story is still unfolding there on that one.
One thing I can say for sure is that part of the reason that Meta is developing things like Llama 3, even if they're not seeing tangible monetary results right away, is it's really about having a defensive posture in AI, right? So in the last era of computing, the mobile era, we know that all the winnings accrued to two platforms, Apple's ecosystem and Google's ecosystem, right? Through the Apple App Store and the Google Play Store. What is going to happen in AI if nobody develops a free open source version is it will accrue to the foundational models that are going to act as gateways for everything AI. Oh, you want to use our API? And you'll always be paying that premium to build all these great applications on top of this foundational AI layer. So what Meta Platforms is doing by making Llama 3 free and open source is they're having developers all over the world helping build out an ecosystem that's free for everyone. There's no more gatekeeper when you're using Llama, which means it's getting developed much faster, much cheaper, and of course to Meta's benefit. So I do think that even if they don't see like a direct revenue stream from this, it's going to do great things for them and open up new revenue streams down the road because they're not going to be forced to go through a Google or an Apple with their next generation of apps and services like they have for every generation before.
Great news for Jensen as well with all those GPUs.
Yeah, for sure. I think Jensen said that Meta has 600,000 H100s. 600,000. And I think they're like 40 grand a pop. So you do the math and it's definitely more than my bank account. Larry, what does Meta stock look like to you?
Of the charts that we're going to talk about today, Meta is the best chart by far. So Meta reported earnings, very nice reaction after earnings, and Meta is near the upper right-hand corner of the screen. So ideally, what I look for is stocks that are showing price strength, stocks that are in this upper right-hand corner of the screen that are showing institutional buying. So Meta put in the recent high July 8th, and it looked like it was ready to go. It looked like it was ready to really break out because the market was probably in tune with what was coming for earnings. The market tends to try to get ahead of these moves. But we got that CPI number, and you can see this big red candle, and then Meta just pretty much went straight down with this rotation. So from a longer term perspective, it's in a big range. I will say I do have a position in Meta. I've had it for a while. So it's in a range between 450 on the downside, and we'll call it 540 to 550 on the upside. And this would be whenever triple Q turns up. It could be, as I said, today or 2 weeks, whenever it is. When triple Q finally shows signs of turning up, Meta is one of the first charts that I would expect to lead that breakout. Meta has a forward PE of 20, and their projected earnings growth of 42% this year, 13% next year, 30% over 5 years. Of the Magnificent Seven, to the best of my knowledge, Meta is the least expensive on the PE ratio, and also it's got the best PE versus growth. So that's something I think the market does pay attention to.
I do think that Mark Zuckerberg will go down in history as one of the most criminally underrated CEOs of all time. He's pivoted the company multiple times. He's led it through many downward cycles and out of many big holes. He's come on top in every industry he's attempted to. He's coalesced an ecosystem of apps that literally everybody uses and that competes with some of the biggest apps and platforms in the world. He's not afraid to pivot when he realizes he's wrong. And this earnings reaction is just another little data point in a long line of data points that I think are going to end up proving that over time. One of the things we should talk about is that Meta's overall advertising revenue, which mostly comes from Facebook and Instagram, was up 22% year over year, which is huge. Compare that to Google, which only saw an 11% year over year increase from ad sales, which is literally half the growth. So let's talk about Google next. Arif, what is going on with Google?
You hit the nail on the head. For Google, the main topic really was their advertising revenues. So in terms of earnings, overall earnings were good. And the revenues there they had were 84.7 billion. The street was looking for 84.2 billion. And earnings came in at $1.89 a share versus $1.84 a share expected. So small beats on both of those. And really, it was just YouTube advertising that actually disappointed a little bit. So YouTube advertising was $8.66 billion for the quarter, but the street was looking for $8.93. So that was the real miss, if you want to call it a miss, really, versus expectations. And that was really what caused the stock to be down. It was only down 2%, though. And one reason for that is the Google Cloud revenue was higher than expected. So they did do well there. So overall, Alphabet's revenues were up 14% year over year. But the thing that pulled the stock down a little bit in the after hours was the YouTube ad revenue being a little bit less than expectations.
So what's interesting about this is Google is getting rewarded for 29% cloud growth, while Microsoft is getting punished for 29% cloud growth, right? I think there's a low-key buying opportunity for Microsoft here. Google is the smallest of the three cloud providers, so it's growing from the smallest baseline. Microsoft Azure is the second biggest cloud service provider in the world. It grew by 29% year over year. And that's incredible. Okay, so Google Cloud, obviously not the only part of Alphabet's massive enterprise. There was also YouTube advertising revenue coming in a little lower than expected.
And it wasn't a huge miss again, although these are big numbers we're talking about. It was 8.66 billion versus an 8.9 expected. But yeah, that could be the source of it. I don't think it's anything to worry about. I don't see YouTube going anywhere as a platform For video, there's obviously other competitors out there, but YouTube seems really well established still. Yeah, you might be able to tell us a little bit more about that, being so close to YouTube and advertising there.
My guess is it's some combination of seasonality and the political cycle pre-election. It just changes the nature of ads, right? And so when you have controversial political content driving a lot of the traffic, ad revenue probably looks a little different as a result, is my guess. Combine that with it being summer, overall availability of eyeballs on media when the weather is nice and kids are out of school just goes way down. So I would expect the combination of those two things to result in slightly worse advertising revenue across the board. But just recently, OpenAI announced Search GPT. So what do we think Search GPT means for the future of Google, of search, of all the ad revenue?
When you're an incumbent, when you dominate search as much as Google do, there's only one way to go, really. And I think it still remains to be seen. But now we have an actual name for a product that could disrupt them. When all of this generative AI first came out, there was a lot of talk about how this is going to disintermediate Google. People will not be just going there to get information. It won't be about 10 blue links. They'll be using generative AI. But it's taken a while for that to come through. And also in the meantime, obviously, Google have been adding these AI summaries to their search results and trying to get on that bandwagon as well, with some mixed results. Right? Things are one step closer to Google being disrupted in this space.
Yeah, I think if anything, this whole AI era speaks to the absolute power that Google has in their monopoly on search. We have been saying Google is under attack for years now, right? Just from the moment ChatGPT came out to things like the Rabbit and the Humane AI pin, Apple Intelligence, Search GPT now. Still, the way most people look up things and try to get their answer is by Googling things, getting 10 blue links. I don't think that's going away soon. And even if it does for some searches, there's all these examples of specific verticals of searches that Google is also very suited for. None of these features are going to displace anything about Google Maps, for example. I'd be curious to see how much longer this monopoly lasts and if we'll ever see a monopoly as strong as Google's monopoly on search. Larry, how strong is Google's chart?
Just like Meta, if we look at the Google chart, it was ready to go. It was ready to break out. We got the CPI on July 11th, and then it's been pretty much straight down. And that's why I believe that a lot of this pullback is more macro-oriented than Alphabet is doing something wrong or Meta did something as far as their execution. What I see as key support on this chart is 150. We can see that was the prior high 2021 before the bear market. So this prior high at 150 now becomes key support for the stock. So 150 on the low side to 160 on the higher side. So there's a lot of support here, 150 to 160, that if this continues to come down, I think that you'll find there's a ton of institutional buyers that will come in at 150. So longer term, I'm constructive on the stock. And I know the listeners might say, Larry's been constructive on every stock we've talked about so far. He must like everything. That's not the case. But when we're talking about Alphabet, when we're talking about Meta, when we're talking about Microsoft.
Yeah, they're magnificent for a reason, right? The big theme here is every company we're covering on this podcast is big tech. That was the safe money when interest rates are high. As we get into a rate cut cycle, it makes sense that the market wants to broaden out away from just like the companies at the very top with the biggest cash reserves that don't need to borrow money. It makes sense that people want to put their money in real estate and in other markets that are more sensitive to lower interest rates. And that is the pattern that we're seeing here, and why so many of the charts are showing a top in the beginning of July and then a bigger downtrend in and including through today. And the only other thing that these companies have in common, obviously, is they recently reported earnings and usually showed at least weakness in one major segment, whether that's slower growth or a revenue miss or an earnings miss or declining margins in the case of Tesla.
Here's the other thing, and that's a great point. And to go what you said, a lot of what happens with stocks at earnings is just based on the market tone, the market cycle. So right now, Triple Q's been in a pullback phase since the middle of July. So really, the market is just selling into these earnings. It's not necessarily that the earnings weren't ideal. If this was a much stronger market, remember Alphabet posted what I thought was not a great quarter in April, but I think they announced a stock buyback and they announced some other things, and the
Right.
stock went much higher. Often what happens at earnings is the stock will react just based on what's the overall tone in the market. But the market tone right now is just very weak for these big tech stocks.
Google's advertising revenue, as we saw, much smaller than Facebook's, right? 22% revenue growth for Facebook in advertising, 11% for Google. The sleeper in advertising has always been Amazon. Arif, why don't you walk us through one of my favorite companies in the Magnificent Seven? What's going on with Amazon?
Sure, yeah. It's a perfect example of what Larry was just talking about as well in terms of a stock reacting to what's happening in the macro, because actually earnings came in better than expected. So it was $1.26 per share versus $1.03 expected. Revenues, listen to this carefully because it's quite a small difference. 147.98 billion was what they announced, and the expected was 148.56. Literally, we're talking about 500 million difference, which sounds like a lot, but it's less than 1% here in terms of the expected versus their revenue. So very narrow miss in terms of the expected revenue. And cloud services, which is something we've been talking about a lot today, Amazon actually beat. So they had 26.3 billion versus the expected of 26 billion. So that all good news so far, pretty much, apart from that small miss on the revenues. And then advertising. This is what really caused the stock to pull back. And we're seeing it pull back more today, the day after earnings. Advertising was $12.8 billion versus 13 billion, which was what was expected. So even though that's 20% year over year growth, the street was looking for a bit more in terms of advertising revenue. And then, as Larry said, if you're already in an environment where tech stocks are under pressure, then even the smallest miss can result in a drawdown of the stock, which is what we've seen today, the day after earnings. I think the stock's down around 10% for the day and around 20% overall in the last month.
What a brutal smackdown. 20% over the last month on top of what is a reasonable earnings call. Advertising, $12.8 billion in a quarter, up 20% year over year. I think most people still are sleeping on the fact that Amazon is the third or fourth biggest advertising company in the world right now by revenue.
Yeah, the advertising numbers, we've talked about this a few times, haven't we? They're huge. They're much
these
higher
are
than
huge numbers. Yeah, and again, I know I hammer this every quarter, but the difference between Amazon and everyone else is people go on Amazon.com with an intent to purchase. People go to Amazon to buy stuff. So those advertisements, they convert at unusually high rates. It's fundamentally different from every other advertiser we're talking about. The other thing I want to talk about is Amazon Web Services, the biggest of the three cloud providers. I believe they grew by 18% year over year.
19%.
19% year over year. So not as good as 29%, but remember, that's from a much higher baseline and with two massive competitors nipping at their heels, Google Cloud and Microsoft Azure. So I do think that Amazon is being unfairly punished for their lack of growth in Amazon Web Services because 18% is massive. What do you think about that?
No, I totally agree. The biggest provider still growing at such a huge level. That is impressive in terms of Amazon's core business. And it's a good company in terms of the fact that you can buy this one stock and you get exposure to the biggest retailer probably out there, as well as the leading cloud services. There's diversification right there in terms of what you're buying when you purchase.
And the fourth biggest advertiser.
There we go.
The fourth biggest advertiser.
A really broad portfolio. On the advertising, actually, one thing that did come in a little lighter, which was another reason for the stock reaction, was the guidance that they gave. Again, very narrow miss, but the guidance was 154 billion to 158.5 is what Amazon announced, whereas the street was looking nearer the top end. The street was looking for 158.24 billion. So again, narrow miss there, less than 1%. They didn't guide as high as people wanted. And what I found interesting, and you touched on this earlier, is seasonality, right? So their CFO literally said one reason why the guide is lower for the next few months is because people are watching the Olympics, and apparently we're distracted by the news and an upcoming election as well. So that is part of the reason it made it into the earnings call, that the Olympics, that's why people are buying less things, apparently.
One thing that we should call out is Amazon's net income doubled year over year, right? So 13.5 billion or $1.26 a share, up from 6.75 billion or 65 cents a share 1 year earlier as a result of massive cost-cutting efforts across the entire company. So net income doubled, the stock is down 20%. Remember a couple years ago when Meta Platforms went from $100 a share to $400? I think we're going to see something like that with Amazon. Everything seems to be lining up except the stock price. Larry, walk us through the Amazon chart.
So the Amazon chart, it's a little bit weaker here right now. Like Meta, like Google, it looked like it wanted to break out, turn down with everything else. But right now, Amazon is below the 200-day moving average, which is the green line. And for a lot of institutions, they consider the 200-day moving average like the key line in the sand. So Paul Tudor Jones, who's one of the most famous hedge fund managers that we know of, has said that he won't buy anything that's underneath the 200-day moving average. A lot of institutions use it. It's not a guaranteed rule, but I will say that when a stock breaks that 200-day moving average, it's considered much weaker. It often starts to bring in short sellers, things like that. So down 9% after earnings. If we take a look at the longer term picture of the chart, so right where it is right now, 160, we'll go back to 2021. So the highs in 2021 were about 180. 160 is a little bit of support, but really just looking at the chart, 160 to 140 is a potential support range. I buy pretty much everything on Amazon. My wife and I use it all the time. I think they've got a lock on what they do. AWS obviously is a giant growth market for them. But just from a technical perspective right now, the chart, I would rank this the bottom out of the charts that we've spoken about so far. And what would make me more constructive on this chart, ideally, is the first thing, I'd like to see it back over that 200-day moving average. I'd like to see it back over at 170. If we talk about that forward PE just for a second, because I know we talked about Meta at 20, Alphabet right now is at 19, Amazon's at 28. So maybe the market looks at that too. I don't know. But Amazon's got a great growth rate, 62% projected this year. 25 next year, 30% over 5 years.
Those are earnings growth rates, right?
Yeah, EPS growth rates. So the analyst community is expecting pretty big EPS growth rates from Amazon, but right now, I think it's just caught on the wrong side of this rotation, and the market didn't like their earnings.
So I think one thing that we've been focused on definitely for the last 2 years at ticker symbol U is making sure we are not catching falling knives. I think that's super important. I want to stress that all 5 of these companies are some of the best companies on the planet, but that doesn't make them necessarily good investments in this moment today. We're seeing a big change in the macroeconomic environment for multiple reasons. We're seeing more and more likelihood of the next rate cut, or of the first rate cut coming soon. We're seeing a close election in the US, which could change a lot of different economic policies. So there's a lot to focus on right now. As volatility goes up, I think it's more important to stay informed, build your cash position, and understand what you're buying, which means understanding the science behind the stocks. This is ticker symbol U. My name is Alex, and I'm joined by Arif and Larry, and we're reminding you that the best investment you can make is in you.